Well, a fabulous discussion on the investment school last week with the Credo Chief Investment Officer, Dion Gous in London, in which we spoke about risk. And the most important outcome from that discussion was that the biggest risk that you take in investing is taking enough risk. How do you do that without being stupid? You can play Russian roulette, which is a stupid risk to take. You may say, well, I've only got 1 out of 6 bullets. What are the odds? I've got an 80% chance of not shooting myself in the head or the foot or wherever you aim. But investing in the stock market, either directly through buying specific shares or through unit trusts where you pay others to do it for you, or via exchange-traded funds which track specific factors and indices on markets, you can do it. Someone, though, is going to be shouting. And why would I do that? I bought Steinhoff shares because my mate at a braai said they were brilliant. And I'd only just recovered from the last time the same guy told me that shares in Tygon and Shorecell were brilliant. The market's a casino. I always lose. And unfortunately, those voices, although few and far between, are very loud, very persistent, and very noisy. So what I've got is the certified financial planner, Warren Ingram, a director and co-founder at Galileo Capital. And Warren, I don't want to perpetuate the myth of the casino, because some people do believe it's nothing better than a roulette wheel where sometimes you get lucky, but most of the time you lose. And I used 2 extreme examples of Shorecell, Tygon and Steinhoff to make a point. But some people, see it as very, very high risk, high reward behavior, but it doesn't have to be, does it?
No, it doesn't. And maybe let's just kick off why it's not gambling, and what's the difference between putting your money in the stock market where truly you can lose money, equally that you could make money, but why is that different to putting your money on a roulette wheel? I'm sure I'll get that word out, or any other form of gambling. And the big deal here is it's not a zero-sum game. In other words, when you invest, it's not that one person has to lose so that another can win. And that's what a zero-sum game is. At the end, each of you, you start with $50 and another person starts with $50. So there's a total of 100. And if I win everything, I get the 100, you get 0. That's a zero-sum game. Investing is a different thing, because what you're doing is you're buying businesses that have the potential to grow their profits, to grow the size of the company, and to move its entire value higher and higher over longer periods of time. And so, the idea there is that you start with 100, and you might be starting with a whole bunch of other people who are each putting in 100, and over time, their 100 becomes 101 and 105 and 110. And so the entire pie gets bigger. And so it's not a zero-sum game. Equally, that you buy a business and it's badly run, or it's in a lousy sector, or bad economy, or another pandemic, or whatever it is, and it goes down, and then the entire pie gets smaller. It still goes less than what you started with. So there is a big difference between the casino and the investor. The problem we've got is that some people look at this and say, I can call a trend. I can pick the bottom, or I can pick a business that is, definitely going to turn. And I can't tell you the number of phone calls I had, after Steinhoff had kind of halved its value, of people saying, this is it. Surely once a big company like that has halved, now's the time. This is, any idiot can see that this thing is going to bounce. And I have to say, I sat there watching it, and thinking to myself, I might be missing the opportunity of a lifetime. I certainly did miss a few of those in the financial crisis, where there were some fantastic businesses at really low prices. But equally, I thought I'm happy to regret a profit I didn't make. I'm really not happy to have to wake up in the morning and go to my wife and say, actually, I've just lost all my money because, I bought something that just went from, 50 to 0. So there is a big difference between an investor and a speculator. And that's the key that people, I think, often miss in this whole thing. Bruce?
Because I did also throw in the line of the Braai Fire. If you're taking stock picks at a Braai Fire, you're not an investor. You are a speculator. You are somebody who is not doing the research, is not doing the work, is not trying to understand stock markets, understand the companies into which you are investing. You're simply acting on a tip-off. A little bit like, that's the best restaurant to go to in town, or look at my haircut, that's the best hairdresser in that particular shop over there, whatever the case might be. It's no different from that, is it?
100% right. And I think, it's interesting this week, there's been quite a lot of press. I guess the public relations machine is kicked in for Pick n Pay. We're seeing lots of being written about the Ackerman family, stepping back from control and their young CEO, jumping into the fire and telling everyone about all the mistakes that the previous management have made and why his experience will turn the whole thing around. Now, we could sit here and have our braai and I could tell you that, Sean Summers is a clever guy and he's done it before. And here's all the good reasons why he'll get it right. And someone else might say, well, hang on, ShopRite's literally eating their lunch every single day and every other competitor's taken them out and they're going to fall over. And the reality is that, the only people that will really know will be all of us in 10 years' time. Then we'll know for certainty. But if you're going to make an investment decision in a company that's, maybe turning around or maybe falling over, you better do some serious homework. And it's not at the braai. It's, looking at balance sheets, talking to retailers, getting to understand what's going on in the sector. And you need to do an enormous amount of homework. Or you
absolutely
give the money to others.
No, absolutely. You can do all of the homework in the world, Warren, and you can still get it wrong. Because ultimately you are, and this isn't my terminology, this is terminology that people, stockbrokers, asset managers use all the time. They say, I can take a bet that Sean Summers will turn it around. Or I take a bet that he won't turn it around. And either they take a long position, in other words, they believe the share price will go up, or they take a short position, believing the share price will go down over time. And they place a bet. Because in the case of a company that is in pretty bad shape, which does require urgent surgery, and it's going through that surgical process, there are absolutely no guarantees that even somebody with all of Sean Summers' vast experience gets it right. He is but one person trying to, orchestrate a massive turnaround. And that terminology of take a bet is the one thing that makes people go, casino. If you're talking about taking bets, then it's not certain. But here's the thing about investing. Although it's not a casino, it's about the furthest thing from certain you can get, isn't it?
You are entirely dealing with probabilities. The probability that, starts with the probability that the sun will rise, probability that, businesses will grow and that, the well-managed businesses will grow themselves faster than their competitors and maybe take their competitors out. So what you're dealing with when you're in the world of probabilities is, what's more probable and what's less probable. And I don't want to kind of turn this into, a math or English lesson, but it's very different to rolling the dice and saying, well, I hope that I get, I land on 6 instead of 1. What you can do when you're investing is you can take a time horizon, and I think that's the key in this whole conversation, is you can say, I believe in the management team. I believe in their strategy. I think I understand the retail sector well enough. I think the South African consumer is looking for alternatives, and it's not going to be online. It's going to, for some reason, be fresh food and, sold in shops. And that's what I'm going to take a view on. Whereas, that's different to kind of 1 or 6 on the dice. You're taking a view based on some homework and some rational thought. One hopes. And you're right. You shouldn't be calling it a bet. But the one big thing, that I think people miss all the time is when you buy a company or you buy the index or a unit trust and it's based on stock markets, your time horizon has to be, this is not a negotiable, it has to be at least 5 years or longer for you to consider yourself an investor. If you're taking a 3-month or 6-month view, drawing money out of your credit card and hoping that you're going to turn it over in 6 or 12 months time and pay back the interest on your credit card and have made lots of money on the growth, that's called speculating, and maybe your risk of the casino might even be better than what you're about to do, and that's just a really lousy idea as far as I'm concerned.
Okay, good. Thank you, Warren Ingram. So, yeah, I mean, again, if anybody wants to fight with Warren, you're welcome to. I won't aid and abet the crime because I agree with Warren on this particular point. And it comes down to also not just buying, if you've got 1,000 Rand, putting your 1,000 Rand just into Pick n Pay, because that's where you are then betting. You're not diversifying. Would you, in a portfolio, and I'm going to use 1,000 Rand, you obviously need more than that to make it worthwhile, but would you then buy shares just in Pick n Pay and then a bank and an insurance company and in a mining company and a construction company and a property firm, and create your own little portfolio of your favorite companies, one each from those sectors? Or do you say, you know what, the big dog in this game is ShopRite? I must give them some money. I must put some money into Pick n Pay. I might even put it a little bit into Spar, because if those international operations take off, my goodness me, there's a big bonus there. And then I'm only not going to put money just into Sanlam because it's got a great Africa play. I like the edginess of a Discovery. I'm not only going to put money into an ABSA because of its valuation relative to the banks, but I'm going to put money into a Capitec as well, because they've shown their ability to convert customers into profit. And I'm not only going to be putting money into Growth Point, but I'm going to be putting money to Redefine as well. How do we diversify to make sure that it's sensible, but not so diversified that actually it would have just been easier to go and buy an index fund of the top 40 shares in the JSE, or a diversified general equity unit trust, or a global unit trust? Warren.
I mean, you're saying that you're almost asking me the question as if that diversification of a global index plus a local index, or a local general equity fund and a global general equity, are bad. And I feel, if I want a high degree or a really good chance that that my money is going to grow over the next 5 or 10 years, that's exactly what I'm going to do, Bruce. I'm not going to take, a view on 5 or 10 or 15 shares, backing my research, and somehow as if I've got the ability to choose the 5 or 10 shares that are going to do way better than the index. I'm already kind of learnt those lessons. I was going to say humble enough, but it's just I've got enough scar tissue on my back now that I know that I can't do that. So it's not a case of diversification being bad. I think there is a thing called over diversification, but buying the top 40 or top 50 shares in South Africa and the world index overseas, and just making that your portfolio, I think is a really good idea. However, if you've got a strong view that you think you've done the research and you believe that there is a company that will do very well, and we're picking on, pardon the pun, we're picking on Pick n Pay today, but if that is the case, then what you do is you take your 1,000 Rand and you buy maybe 950 Rand in the index, because what you want to know is you've got some money that's going to grow in case you are wrong, and truthfully, there's probably a very good chance that you're going to be wrong. Not because of anything other than most stock pickers are wrong. So just go with that attitude to start with, and allocate a small portion of your money and buy the share that you believe in. And if it does incredibly well, you can call us back in a year or 5's time and tell us that we were silly and you were right. But you won't be regretting the index. That's probably done not bad anyway. And that's the point, is the one thing about investing is you start today with the assumption that you've got a set view on how the world's going to work, and well done. You invest according to that. And maybe you take 60% of your money and you do that. What you should also do is take 40% of your money and invest as if your thesis is wrong. And the best investors over long periods of time are really humble, because they know that very often they're wrong. So they don't take that Russian roulette bet that you were talking about, Bruce, and wipe themselves out with strong conviction in a few shares or in one particular direction based on one forecast, or let's call it a bet.
Yeah. So, I mean, all of the founders I've ever spoken to of companies that have made it to listing on the stock exchange, and I've been through many projects where I've done this and interrogated and studied these businesses and interviewed the CEOs and the founders. Without fail, all of the serious players, in response to the questions, how did you make your growth decisions? They always said, never make a growth decision that can break you. So if you're taking a big bet, if you're making an investment in a new firm or in a new product line or whatever the case is, set a limit as to if it fails dismally, how much of your business will still be left? Will it be 80%, 90%? That's preferable. You want to take some fairly significant positions in businesses, but you also want to make sure that they're not big enough to break you. In the same way as your investment strategy shouldn't be that you were 90% in Steinhoff because the Bryfire guys told you it was great and you put 10% as a hedge in the general equity unit trust, because then you would have lost 90% of your money or 85% of your money by the time it all went awry. But Warren Buffett is the antithesis of this. After decades of diversification and common sense, he went in through a whole bunch very successfully into Apple. It makes up a huge proportion of the assets of Berkshire Hathaway, the company whose money he manages.
I mean, when you say a huge proportion, I think it's, I mean, your memory's always better than mine, but I don't even think it represents just the cash that Buffett's still sitting on that's growing almost exponentially every single day. So I think he took a considered view. He did an enormous amount of homework, and we have to say, he didn't go and overinvest just in the tech sector. I think, it's probably, maybe an exaggeration, but I think it's very close to his only big, kind of call on the tech sector. And it's a great diversifier away from energy, railway lines, insurance companies, and all the other things that he owns. And what's happened is it's been a successful call. So it's become a bigger and bigger holding for him, but certainly, he didn't bet the entire Berkshire Hathaway business on one share, and he's never done that. He might be concentrated on very big acquisitions and riding those acquisitions for long periods of time, but equally, when he makes a mistake, and he loves to talk about his mistakes. He'll tell you this was a 5% allocation, and we, it went from 5 to 3. We'd made a mistake and we sold out. He doesn't go and make a 55% allocation to of his entire capital to a business and then watch that lose 25% of its value. So I think he's still diversified, and I think it's almost like a unit trust now, Berkshire Hathaway. It's so big, and it's not even an equity unit trust anymore. It's a balanced one because they've got so much cash.
Sure. I want to get to Terry's question. I'm going to give you a moment to think about it. Terry and his wife retired about 7 years ago, loving it. One of their kids is in another province, another in the UK. They will want to carry on visiting them, but they also at some point know that they're going to need some help. They're going to need caregivers. They want to know how to know when the right time is to move to a retirement village. And this is the conversation I'm sure you hear often as well, Warren. That question and an answer in 2.5 minutes in a moment.
The Money Show.
Personal Finance with Warren Ingram.
Terry and his wife happily retired, traveling, seeing the world, visiting their kids. But at what point do they need to be thinking about the dreaded retirement village, the assisted care? Is there a benchmark here, Warren?
I think the answer is as early in retirement as possible and from as strong a position as you can, both health, medical, financial, all of those things. I think I'm going to challenge you on that dreaded, because I think, making this as a positive choice where you go into a kind of a good lifestyle village, where there's, not just a bunch of people that are all 99 years old and not knocking on the door we don't want to knock on. There are lots of people that live in these 50 plus villages that have a great time and travel the world and, very relatively young. And I would say to Terry, you do this, you make this decision and in fact make the move early so that you do it when you're strong, when you're healthy, not when you're forced, because change as we get older is a real problem. It's very hard for us to kind of adapt to that change. It's traumatic and all of those things. So you do it early and then you carry on your travels without worrying about this. The big trick is make sure that it does have assisted care, that you're not having to then go into queues and waiting lists for caregivers. Make sure that whatever you're choosing, the place that you're choosing, you do get immediate access when you need it, and let's hope you never need it. But I think that would be my choice, Bruce, is to do it fast and then make sure that you're not choosing some kind of lousy place unless you're forced by circumstances to choose the cheapest place you can find.
Eminently sensible, Warren. And I mean, when I said the dreaded, I'm obviously putting my own biases onto this because, there are some absolutely perfectly lovely lifestyle developments where people go in. And don't be caught up by the promise. If you go into a new development, my parents got caught up by this. Oh no, there'll be a sick bay and there'll be this. I took one look at this development. I went, you got suckered. And 20 years later, I think the place is still, I think it's now a lounge or something for visitors, where the residents can go and chill away from home if they need to get out a bit. But beware, T's and C's most certainly do apply when it comes to these places, and you need to have your wits about you. Warren, briefly.
Absolutely. Do the homework, especially look at the financials of that homeowners association or body corporate or whatever it is, and talk to the people who are there. Get references, make sure that the people are happy. If it's brand new, find out what other developments the developers have done, and talk to those people.
Do that. Warren Ingram, thank you.